Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me from the market site in Times Square, we have Phil Mackintosh, chief economist at Nasdaq. We're going to take a look at the Fed's delicate balancing act of how they need to keep this economy not too hot and not too cold. And Phil, before we get into that, I mean, let's say goodbye to April. That was one of the ugliest months we've literally seen since the great financial crisis.
For equities? Yeah.
Yeah.
Worst month we've seen since the financial crisis. It's not as bad as it looks, though, because we've kind of had a drawdown and then a recovery. So actually this is pretty normal for a rate hike cycle to be down sort of 10-15%. But what else made the last month interesting is the bonds were down multi-decade falls as well. And so that's pretty unusual. Usually bonds are a bit of a hedge to equities, but actually in April both of them fell quite a lot.
Right. Well, so what's going on here? It feels like it's all coming back to inflation and yields.
Exactly right. So what we're seeing is the interest rates have been coming up for the last 6 to 12 months. You sort of think about when we sat here at the end of last year and the 10-year was 1.5%. Now it just peaked over 3% this week. So rates are going up really quickly. The 2-year rate's going up really quickly because everyone thinks inflation's running, to your point, the economy's running so hot, inflation's so strong that the Fed's going to have to come in and do a lot and do it really quickly. And so everyone's starting to panic a little bit.
Well, I mean, there's that expression, the Fed will hike until something breaks, and their job is incredibly delicate. You don't want to be too hot, you don't want to be too cold, you don't want to raise rates to the point where there's no consumer spend, because then you have a whole other set of issues, and it's not just raising rates that the Fed has to contend with. We have supply chain issues. We're still somewhat in the middle of a pandemic. There's a lot going on here. Yeah,
and yet the current market expectation is the rates are going to go up fastest almost ever. So, we're going to get to close to 3% in 12 months. The rate of the Fed hikes, 0.5% at least at the moment for the next 2 meetings is going to get us with much higher interest rates, much higher mortgage rates we're already seeing relatively quickly. And so that's all happening at the same time as, to your point, the consumer is starting to slow down because the stimulus payments are now nearly a year old. And we're starting to sort of pivot back into spending on services. So all of the supply chain issues on the product side are becoming less prominent. Some of the chip shortages are alleviating, so cars are restocking, inventory is restocking. Everything is actually starting to get back to normal at the same time as the Fed is doing a bit of catch-up, because with inflation at 8.5% and interest rates until today at less than 0.5%, they have a big gap to close.
Yeah, and I think the housing market is so interesting. I was reading that 90% of markets in the U.S. are considered unaffordable now, especially with rents where they are. You can't save to buy a home. Conversation for another time. Let's talk about one area of inflation that's actually declining.
The core inflation, which we've been kind of expecting to happen for a long time. And the reason that we have core and headline inflation separated is the headline is everything, including energy and food, which tend to go up when there's shortages and down when there's supply and surplus. Whereas core inflation are the kinds of items that we don't see prices change so fast. And we're starting to see that come down already in the PCE, not in the CPI. But the outlook for even the CPI, if you look back 12 months, that's when all the prices started to rapidly increase because we had the supply chain bottlenecks, because we had oil prices going up. Now that's 12 months old, we're going to start to see things are going to fall out of the CPI. So even though the prices might stay where they are now, the inflation rate slows down. And so that's good news for the Fed as well.
All right, Phil, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.